The biggest wealth-building window almost never opens when people feel optimistic. It opens when people feel fooled. That is the part almost nobody understands until it is already over. They think opportunity should feel exciting, obvious, and socially approved. They think the best time to build wealth must be the moment the economy feels strong, the market feels friendly, and everybody around them seems to be making money without effort. That is usually the opposite of the truth. The real window opens when prices have already fallen, when fear is louder than logic, and when the same assets that looked brilliant a year earlier suddenly look dangerous simply because the mood changed. That is where serious wealth starts. So let me give you the one mother line that everything in this story serves. The once in a decade wealth window does not open when safety returns. It opens when prices break before confidence does. That is the line. Not optimism, not headlines, not the moment your friends finally tell you it feels okay to invest again. Dislocation. Because dislocation is what gives ordinary disciplined people access to extraordinary prices. A great business does not usually become cheap because its soul changed. A sound long-term asset does not usually become attractive because the world suddenly discovered its value. It becomes attractive because the cycle forced price below comfort. That is what creates the opening. And if you do not understand that, you will do what most people always do. You will wait until the fear is gone. You will ask for more clarity. You will hold cash until the news sounds less threatening. And by the time the environment feels safe again, the sale will already be over. That is how the public misses almost every real wealth window. Now let me show you the mechanisms. The first mechanism is fear freeze. People like to believe they miss opportunities because they lacked information. That is flattering, but it is not usually true. More often they miss them because they could not emotionally tolerate acting while prices were still falling. Their brain interpreted the decline as danger rather than discount. Their instinct was not to evaluate. It was to retreat. That is fear freeze. When markets fall and recession language starts filling the air, the natural human response is to stop moving, pull back, preserve cash, avoid anything that could hurt more. This is not because people are weak. It is because they are wired to read falling prices as proof that something must be wrong. Sometimes something is wrong, but the market rarely distinguishes cleanly between broken assets and temporarily discounted assets in the middle of a broad fear event. It throws both into the same emotional blender. That is why fear is so expensive. It turns a market-wide markdown into a psychological stop sign. This is also why most people build very little wealth from major downturns, even though the raw ingredients for wealth are sitting right in front of them. They are not blind. They are frozen. That is the first edge you need to understand. The opportunity is not hidden in secret information. It is hidden behind ordinary human hesitation. Now let us move to the second mechanism. I call it crisis markdown. When the cost of money rises, when recession fears spread, when earnings expectations soften, and when investors who bought in a euphoric regime are suddenly forced to reassess what they are willing to pay, assets get marked down. That pain feels catastrophic if you are experiencing it as a holder. It looks completely different if you are experiencing it as a buyer. That is crisis markdown. A market can take the same company with the same products, the same customers, and broadly the same long-run franchise and reprice it 20%, 30%, or 40% lower. Simply because the discount rate rose, the crowd became more fearful, or the market stopped paying bubble multiples for imagined perfection that matters enormously. Because wealth is not only built by picking the right thing, it is built by picking the right thing at the wrong emotional moment. If you buy a strong business when everybody loves it, your future return starts from a stretched price. If you buy that same business when investors are treating everything cyclical, risky, or unfamiliar as contaminated, your future return begins from a much friendlier point. That is the markdown. The public experiences it as loss. The disciplined investor experiences it as repricing. Those are not the same thing. Now let us move to the third mechanism. I call it time compression. One of the most misunderstood truths in investing is that the best long-term returns are often created in very short periods of time. A decade of disciplined investing can be transformed by a handful of weeks or months in which the market reprices violently and then begins recovering before the public is emotionally ready. That is time compression. The problem is that most people are waiting for the all clear during exactly the phase when the market is moving fastest. They imagine they are being prudent by sitting out until conditions feel stable again. But the most explosive recovery days often happen inside the ugliest environments, before newspaper language improves, before economists become cheerful, before the average person feels brave enough to act. That is why missing a few key windows destroys long-term compounding far more than people realize. You do not need to be perfect for 20 years. You need to avoid being absent during the handful of moments when the market is resetting upward from fear. That is why systems beat emotion. If you rely on courage in the moment, you will probably fail in the moment. If you rely on structure, schedule, and long-term reasoning, you have a chance to participate while your emotions are still trying to talk you out of it. Now let us move to the fourth mechanism. I call it quality sorting. Not everything that falls is a bargain. This is one of the most important things in the entire story, because shallow optimism in a downturn is just as dangerous as shallow fear. Some companies fall because they were absurdly overvalued. Some fall because they never had a real business under the story. Some fall because they depended on cheap money and borrowed time. Those are not the same as good companies whose prices got dragged lower by the cycle. That is why the wealth window requires sorting. Can this business produce real cash? Does it have real customers? Does it have a durable product or service? Can it survive a tougher financing environment? Is its current price lower because the market is frightened, or because the business model itself was fraudulent, fragile, or inflated? That is quality sorting. A crisis does not suspend judgment. It demands more of it. The extraordinary opportunity in downturns is not that everything becomes attractive. It is that quality and garbage often get sold side by side for a while, and the investor who can still distinguish between them buys future strength while everyone else is liquidating everything together. That is the real skill. Not bravery alone, not optimism alone, disciplined selection. Now let us move to the fifth mechanism. I call it automatic accumulation. The most powerful wealth building tool available to ordinary people is not genius. It is a system that keeps buying when their emotions would otherwise sabotage them, a fixed monthly contribution, a broad diversified portfolio tax, advantaged accounts where possible, no need to guess the exact bottom. No need to predict next quarter, headline. No need to become a macro prophet, just accumulation that continues through the ugly period instead of stopping, because the ugly period feels psychologically persuasive. That is automatic accumulation. Its power is simple. When prices are high, you buy fewer units. When prices are lower, you buy more. When everyone around you is panicking and discounting the future as if it permanently shrank, your system keeps taking the other side that matters, because the investor who waits for emotional comfort usually restarts after the best part of the move is gone. The investor whose process continues through the markdown emerges owning more at better prices without needing perfect timing. That is how ordinary people quietly build extraordinary outcomes, not by finding one magical trade, by letting fear create discounts and letting a system keep purchasing them. Now we come to the sixth mechanism. I call it income leverage. This is the part most market discussions ignore because it is less glamorous than stocks or real estate, but it is foundational. The most powerful engine for building wealth is still your ability to generate investable surplus. A better income stream, a rarer skill set, a business that throws off cash, a side venture with high operating leverage. These are not distractions from wealth building. They are the fuel, that is income leverage. A downturn can actually widen the gap between people here. Those with adaptable, valuable, hard-to-replace skills tend to maintain or even improve their position, while others stagnate. Every extra dollar of income you can direct into quality assets during a markdown phase has far more long-term value than the same dollar deployed when everything is already expensive and comfortable. This is why I reject the narrow idea that the opportunity is only in the market. The market is one piece. Your earning power is the force that allows you to exploit the market repeatedly. If you improve your income while the cycle is creating better entry prices, you are doing something much more powerful than simply hoping a stock rebounds. You are multiplying the amount of discounted future you can buy. That is a huge difference. Now, let us move to the seventh mechanism. I call it delayed safety. This may be the most important psychological principle of the entire story. Safety in investing is delayed. The right thing usually feels wrong. First, buying after a markdown does not feel safe. Increasing contributions during a recession does not feel safe. Holding through a drawdown does not feel safe. Allocating into quality while the financial press is still grim does not feel safe. It becomes obvious only later. That is delayed safety. This is why wealth-building windows are missed so consistently. The public wants present comfort and future return at the same time. Markets do not usually offer that package. They offer future return first and emotional comfort later. If you insist on receiving the second before you commit to the first, you usually pay a much higher price. That is how cycles punish hesitation. Now, I want to force the identity shift, because without it, this still sounds like a motivational message instead of a concrete investing framework. Stop thinking like a dip watcher, start thinking like a cycle buyer. A dip watcher stares at price and asks whether today feels scary. A cycle buyer asks where we are in the revaluation process and whether quality is becoming more accessible. A dip watcher waits for confidence. A cycle buyer waits for value. A dip watcher wants to feel calm before acting. A cycle buyer understands that calm is usually what you purchase with higher prices later. That is the stronger identity. Because wealth is not built by reacting to every move. It is built by participating correctly in the parts of the cycle that the average person finds emotionally unbearable. Now let me give you the operating system. First, accept that the opportunity arrives before emotional comfort. If you need the fear to disappear first, you will probably miss the best part of the move. Second, separate markdown from impairment. Falling price alone is not enough. You still need quality, earnings power, and durability. Third, automate accumulation. A monthly system beats mood-based courage almost every time. Fourth, use tax. Advantaged accounts aggressively where possible. The combination of lower entry prices and long tax, freer tax, deferred compounding is enormously powerful. Fifth, improve your income engine. Skills and earning power multiply the effect of market dislocations by increasing how much discounted value you can accumulate. Sixth, ignore the noise. Most financial media is designed to monetize your anxiety, not build your fortune. Seventh, think in years and decades, not in weeks. Wealth windows are opened by short-term fear and captured by long-term discipline. That is the heart of it. The public thinks the sale begins when markets feel obviously broken. The better reality is that the sale begins while the system still functions, while prices are already lower, while fear is spreading, and while most people are still debating whether they should wait longer. That is why it feels so uncomfortable. That is also why it is so valuable. Now let me end where this really matters. You can keep telling yourself you will start when things stabilize. You can wait until the economy looks better, the market looks safer, and your own emotions stop objecting. You can sit in cash, call it prudence, and re-enter when prices are already higher and the crowd has returned. Or you can do the harder thing. You can accept that real wealth windows are not emotionally generous. You can start now. You can buy quality during the markdown phase. You can let a system work while fear is still loud. You can build the habit, the skill, and the portfolio that turn dislocation into long-term ownership. That is the threshold. Because this opportunity is not rare because nobody can see it. It is rare because very few people can behave correctly while it is open. That is the mirror. Look into it carefully if you want future wealth. You may have to act while present conditions still look ugly. That is not unfair. That is exactly why the window exists, and the people who walk through it will not look brave at first. They will simply look early. Later, everyone else will call them lucky. They were not lucky. They understood the cycle before the cycle made it comfortable.